For now, I am delighted to invite our keynote economist, Claudia Sahm, to the screen. Claudia is a well-known, highly regarded Washington-based expert on monetary and fiscal policy and forecasting. She has several years of experience advising decision makers at the Federal Reserve, White House, and Congress. She created a widely used and highly accurate recession indicator, the Sahm rule. Claudia is the founder of Stay at Home Macro, which, if you follow along, is a play on her last word, or her last name. We'll give her the last word today, too. And Sahm Substack. Previously, she was a section chief at Federal Reserve and a senior economist at the Council of Economic Advisors. I'd like to welcome Claudia.
Great. Thank you. I'm really pleased to be here today via Zoom. I had planned to be with all of you. Getting out of Washington, D.C. is something I love, and I love talking to people who are actually living in the real world, like you are what make it all happen. Unfortunately, about 2 hours before I was supposed to get on my plane Wednesday, I tested COVID positive. So it's best that I'm here and not with you. But I do very much appreciate the organizers accommodating so that I could give the talk this morning. Some of you a very cheerful talk, but you know, I'm going to end in an encouraging place. All right, so let me go ahead and share my screen. All right, like I said, we're going to talk about, are we in a recession? And if not, could we be there soon? And this really is all in the spirit of thinking ahead and planning. As a macroeconomist, as someone who started at the Federal Reserve in 2007, right before everything fell apart, as someone who was advising Congress in 2020, right before it all fell apart, I know that it's important that we plan and prepare and be clear-eyed about what, you know, could be around the corner. Okay, so but before you hear what I have to say about recession risks, let's go to Fed Chair Jay Powell. He's one that's going to make some big decisions that probably put us in, well, raise the risk or lower them of a recession. So at the press conference after the last Federal Open Market Committee meeting, where they raised interest rates, their policy rate another 75 basis points, or 0.75 percentage point. He was asked by one of the journalists, so are we going into a recession? And he was very clear, and I think the Fed is becoming more concerned that this is where we could be headed. They always stress we need to restore price stability, which means get inflation back down. It's going to be hard. And Jay, and I worked for him, he was a governor and then the Fed chair before I left in 2019. And he's a very honest person, right? He's like, we don't know. There are hundreds of economists, many, many people who work at the Fed. They're some of the most dedicated people that I know in terms of public service. If I could give them a crystal ball, I would, but they don't have one. So he's honest about, we don't know if a recession is coming, and we don't know how bad it'll be. It could be a mild one, which is still bad, or it could be a severe one. And then he talks about, well, what does this depend on? Right? We don't just do a forecast and not, you know, think about the story behind it. They need to see inflation come down. They need to see people not expect inflation and then start changing their behavior. But there are a lot of paths forward, some that could be much less pain than others. But the Fed is absolutely committed to getting inflation down. They tell us over and over again that they think low inflation, price stability is what it takes for us to have a sustained expanding economy, a good labor market. And they're of the belief that if we don't do it now, get inflation down, it will be very painful in the future. Okay, so that's what and he really speaks for the Fed. So this is where their mind is. Oops, other way. Okay, so I disagree on some counts with the Fed. Well, first, and you know, the Fed, actually, we agree on this point. It is highly unlikely that we are in a recession right now. at least as we would typically define a recession. And I'll come back to that. And above all, it's the labor market is really strong, which is not a signature of a recession. The underlying pace of growth is slowing, right? So we are seeing the economy cool off some, but we're coming from a place of strength, growth that had been really strong and frankly wasn't sustainably strong, right? We were coming out of, the recovery. And so in some ways, what we're seeing is getting back to normal. But that doesn't mean we don't like backtrack even, and start contracting. Absolutely, inflation remains high. The Federal Reserve got a reading on their target inflation rate this morning, and it stepped down some from last year, but it's still too high. Now that said, there's a lot of signs, and I'll talk about some of them, that there are factors that are coming towards us that could lower inflation. And it's not just about the Fed trying to slam on the brakes, because they're not the nice way that we solve inflation. It's about getting demand down, making it harder for us to buy stuff. And the last thing, and I feel very strongly about this, and I've written on my Substack, Stay at Home Macro, the Fed's wrong about the pain. A recession is extremely harmful. Severe recession is much worse. The pain from that, the destruction, lasts for a long time, as we saw after the Great Recession. I agree they should be raising interest rates. I agree we need to cool things off. We need to get inflation down. The Fed has the ability to do it really fast and aggressively, or to be measured in their rate increases. I disagree with how aggressive they're being, but I still think there's a path that we don't have a severe recession. Okay, so all right, you're gonna have to excuse me. We'll see how many cough drops it takes to get through this. I've been asked, as was mentioned, I have a recession indicator, the Sahm rule, which I didn't name it the Sahm rule. I'm a little more modest than that. But the reason I developed it was I had a proposal that as soon as a recession starts, get out money to people. I've done a lot of work on the stimulus checks. I was a big advocate of every single round of it. I told members of Congress I would have maybe made them a little different in size and timing, but I'm glad that money got out to families. It meant a lot, particularly to families with lower moderate income. I'm thrilled to hear that you all are using the rescue plan money that went to communities. A lot of states turned it down, and that was probably the first thing that was going to go in the rescue plan. And I also argued that, communities needed money. And that you used it for marginalized groups. It warms my heart. Okay, so I get asked a lot about, are we in a recession? At some point, to give myself peace of mind, I was like, fine, we're in a recession. We're in a job full recession, which is actually not a recession. So as long as people keep their jobs, that's why we hate recessions. So, anyways, but we'll get there on the jobs. So I firmly believe we're not in a recession, but we may get there, and we should be prepared for that. Okay, so there's been a lot of talk in the news, and we got an update on these data yesterday. It is the fact that GDP fell the first 2 quarters of this year. Those are the two furthest sets of numbers here. And the first two, I just want to make the point, GDP was growing. GDP, the total growth of those little black dots, it was growing really strong second half of last year. Again, things like that aren't sustainable. I'm really sorry about the coughing. But we do have the declines in the first and second quarter. A rule of thumb people use, which I don't think is the right, and honestly, the official recession daters wouldn't use this either, is 2 declines in GDP at the quarterly rate in a row. And that's what we have. Now, there are some very special factors. One, it was net exports. The next quarter, it was the change in inventories. These are really volatile. You can see that from the second half of last year. These green bars are what you can think of as like the core, the underlying pace of GDP. This is the thing we really paid attention to at the Fed, is consumer spending and business fixed investment, things like housing and research and development, structure. So really the things that businesses, like many of you in the room, will put your money towards. And those things, even after taking inflation into account, they rose in the first half of this year. Typically in a recession, that 2 quarters of GDP declines, those would be ones that we'd be looking to decline. They haven't, but they're clearly slowing relative to last year. Now, again, don't look at quarter by quarter, kind of average out first half. We can get head faked by one number. So that's good, but it's a little worrisome. Though actually the numbers for the third quarter look better. So but 2 quarters of GDP growth, that's not enough. And what's really encouraging, and again, this isn't a recession. The labor market is showing signs of strength. Like, these are really good numbers. So far in 2020, and we have the data through August, we'll get the next read very soon at the beginning of October. There on average is 400,000 jobs created every month so far this year. That's about twice the pace before COVID. I mean, this is a really strong recovery. The last 2 recoveries in 2001 and 2008, they're what's called jobless recoveries. The jobs were the last thing to come back. That's not what we have right here. And this is really good for workers, especially those with low and moderate income. There's a big question. The Fed kind of sees the labor market as the enemy right now because they think it's a factor. Wages are going up and that feeds into inflation. There's actually not a lot of evidence that that's the biggest driver of inflation right now, but it could be. This is, we've got an overheated labor market. There are labor shortages. To me, seeing these kind of payroll numbers, that's like people coming back to work. The best way to solve the labor shortages with labor, not less customers. Okay, but like I said, there are a lot of people that disagree, and some of you in the room may really feel like we are in a recession, and you are not alone. This is a national survey run out of the University of Michigan, the consumer sentiment, and this goes back all the way to right after World War II, and ain't looking so good, right? There's been a little bit of improvement in recent months as gas prices came down, but these are at levels that are a recession, right, and a pretty severe one. So yeah, but it's been really low for over a year now, and like, we're not in a recession. Now, inflation is very high, and I know in using these data that it all just kind of seeps together. Like, if you're feeling bad about the world and the economy and the prices you pay at the pump, it's going to show up in these sentiment numbers, even if, inflation is not a marker of a recession. Anyway, so I take people, face value. They tell me what they think, but this doesn't appear to be a recession. In particular, people are really angry and upset for a lot of reasons, but it's not changing their behavior. They're still going out and spending. Y'all are still hiring. Anyway, but people aren't happy, and that's not a good place. Okay. Oh yeah, so we're going to talk about the labor market a little more. Again, more workers is better than fewer customers, right? Like, inflation is essentially too much demand and too little supply, right? So in the labor sense, if things cool off, you don't have customers, you're not gonna need as many workers, right? That's lowering demand. A much better way is to see people come back to work. So then we can stay in a place where we're still growing and people are, getting paychecks. Okay, so businesses still need workers, and I would imagine those of you in service sectors are really still struggling to get enough workers. And this has been the case for, since last summer. So these are job postings, job openings across, this is for the country as a whole. There's a lot, like tens of millions. This is the highest we've seen. This series doesn't go back all that far, but we've got about 2 job openings for every unemployed person in the United States. Remember, unemployed, you got to be looking for work, right? So that it's not like there's 2 for everybody. This is like twice pre-COVID. I mean, this is just a lot of people looking for work. The happy story is here that as things cool off a little bit, companies, businesses decide they don't need to hire as many workers, and so they take some of these job postings off. Now, hopefully that comes before the layoffs come. So we'll see. This is highly unusual. So we don't, as with a long list of things that have happened in the last 2.5 years. So we'll see. One of the ways you get workers back is you pay them better. And I honestly think it's not just about the take-home pay. I know a lot of workers that are in service sector, lower paying jobs. They have irregular hours, and probably for reasons about the business needs, but it's really hard to plan. And so there are dimensions of making the job better that don't always involve paying them more. But that's, that wage growth, it puts pressure on the bottom line. And you gotta make money to keep going too. So, but as these labor shortages ease, like as workers come back, then there's not as much competition. So these wage pressures, and we've already seen it on a national level, seem to be cooling off some, but there's still a lot of pressure. Okay. Inflation, like really, this is the big question. It's high. When does it come down? And it's, I think for a lot of people, not just the Fed, and it's just, it's really taken over how we're thinking about the world. The first thing I'd like to say, and this actually ends up hitting a little closer to home than usually when I give a talk like this, inflation right now is both demand, like people have a lot of money, they're going out and spending, there's a lot of pent up demand, like they hadn't taken a vacation in 2 years and probably got overwhelmed. And that's the kind of demand driven inflation. That's the kind of thing the Fed can cool off. Interest rates higher, a little less demand. But unfortunately, about half of the inflation that we have seen, and these are estimates from the San Francisco Fed, a very careful analysis, about half of it's supply driven. And that's COVID, that's Putin. This is like real problems that we've had, disruptions that, frankly, I thought a lot of people at the Fed thought were going to resolve faster, and they haven't. But we are seeing some signs of it getting better. This last little bullet at the bottom. You may hear some of my peers like, we need a recession. The only way to get inflation down is a recession. This comes from a tool called the Phillips curve that was developed in the late 60s. This is absolutely not appropriate when you have supply-driven inflation. Like the Fed can't bring that down. Anyway, so when you hear them say we need a recession, we do not need a recession. We may get one, but we don't need it. Okay. Something you'll hear the Fed talk about are inflation expectations, and they want to keep them, quote unquote, anchored, which just means they don't want them. What the Fed doesn't want to see is people expecting more inflation, and what can happen, and this happened in the 1970s, you can develop an inflation mentality, and then you actually change your behavior. So this is from a question where they asked people, same Michigan survey, do you think it's a good time to buy or a bad time to buy? And for the people who say a good time to buy, which right now is not that many people, but if you say it's a good time to buy it, they ask, well, why do you say so? In the 1970s, you saw this peak of it's a good time to buy in advance. So that means you think inflation's coming, you buy more now. Well, guess what? That extra demand, that pushes up inflation, right? So it's this self-reinforcing spiral that is very bad. We don't want that to take hold because that's going to push inflation in the opposite direction of what we're trying to do. There's like no signs of this in the data. But the Fed will say, they admit the inflation expectations have not moved, but they could, right? So there's a risk. I don't think this is sufficient to justify the aggressive tightening they're doing, but they're the ones in charge of inflation. Okay, so this is a happier part of the talk. So inflation, is there relief ahead? What are we watching for? This is why I think we're gonna I'm more optimistic about avoiding particularly severe recession, because I think that we have factors in train that are going to help push down inflation and will allow the Fed to kind of back off a little bit. But we'll see. It's a little bit of a race of time here. If this stuff comes faster, then the Fed keeps moving. Okay, so, and I hope that you all are starting to see this where you're at, but nationally, workers are starting to come back. This is the labor force participation rate of prime age workers, so 25 to 54. It doesn't look as good when you put the older individuals in, but what you saw is a very unusual, just plummeting of labor force participation right when COVID happened. These weren't people getting laid off. These were people just walking away, whether it was to take care of kids or you had like to stay safe or, I mean, whatever reason. This was very unusual to have that big of a drop. It's taken quite a while for it to come back. We have seen continued progress this year. We're getting really close to pre-COVID, but we've got a lot of demand, so that's honestly not good enough. Oh, and I keep saying over and over again, more workers would be the best solution here. Hopefully. Okay. Another encouraging sign, and this is like, consumer price inflation has remained high. It's stepped down some, it is still too high. We are seeing much clearer signs of producer price increases slowing down. So this is kind of in the pipeline. So those of you who are businesses, on average, your peers across the country, and this is for final consumer demand goods. So this is like stuff that you could bring in wholesale and then get out the door selling to customers. On average, across these kind of goods, they're still increasing in price, but at much lower a pace. So that means inflation stepping down, because inflation is a price increase. This will eventually slow into consumer prices. How much? Depends on businesses. Like businesses are who actually set the price tag. Consumers will tell you if they're willing to buy it or not. But there's a lot of factors that go into what it takes to run a business. So, but that eventually typically would pass through to consumers and bring down consumer price inflation, but it can take a while. The last point I wanted to make with this, and this is not for me a happy point. I spent the last 2 weeks in Germany. I was advising policymakers and experts there on the kind of relief that you can do to households in a recession that is the least likely to push up inflation. So this is based on research that I have done in the past. And honestly, like, it's really bad in Europe. They're facing a much, much harder winter and frankly into next year. Those of you who are in tourism, and I know Germans like to do tourism. I was married to a German for 10 years and I've lived in Germany for a couple of times. And I mean, they work to live, right? And part of that is traveling, and especially traveling abroad. And that in all likelihood is going to slow down because the situation there is really bad. In any case, the Fed, we're not like really making it better for them. As the Federal Reserve raises interest rates very rapidly, that makes holding treasuries, holding assets in the United States, or especially treasuries, not necessarily stocks, that makes it more appealing to people outside of the country. And we're also a flight to safety. As the world gets worse economically, people want to come here and buy. US treasuries are the safest thing you can buy in terms of putting your money. And that means, well, to buy those things, you got to have dollars. So that means we've got a lot of demand for dollars. The dollar has strengthened. That means we can buy stuff more cheaply. I had a great exchange rate when I went to Germany, the 2 weeks. So that means in some sense, we are importing lower inflation, right? Because again, as imported goods prices fall, and a lot of our goods come from overseas, then like it's cheaper for us. That pushes down on inflation. Again, eventually, businesses decide how quickly we're exporting inflation, right? For these countries, to the extent that they import from the United States, this is not good for them. They already have really high inflation. The Eurozone this morning posted year-over-year inflation of 10%. That's the first time they've hit double digits in a very long time. Now, that's mainly energy. They're much more supply-driven. Putin is wreaking havoc, both economically and in terms of the war in Ukraine, but it's showing up in other places now too. And other central banks are, competing a little bit with the Fed here. So our monetary policy is designed, the Fed's mandate is for the United States stable prices and maximum employment, but we're the largest economy in the world. We have an effect on other parts of the world, both developed and emerging markets. This will help us get our inflation down, but if the rest of the world goes into a recession, it's that'd be tough to get through. But the United States is going to come out of this the best of any country. So take that for what it's worth. Okay, so the last point, and I definitely wanted to make sure I got to hear lots of questions because I always learn from groups like yours. So the Fed, and I've talked about this a few times, the Fed is considered the institution that fights inflation. I think I know that is a misguided and partial view of inflation. The Fed absolutely has a role. They have a mandate. Like, this is part of their job to keep prices stable. They have determined, well over a decade ago, that the way they interpret their mandate of stable prices is 2% inflation in what's called the personal consumption expenditure prices. It's a little bit different than CPI. It tends to run a little bit lower, because housing isn't as important in it. But we're well above 2%, right? So it's running about 4.5 over the last 4.5 over the last 3 months on an annualized rate. But the Fed, as I said before, they can't fight the supply side inflation. Jay Powell can't go out and drill for oil. He can't unload the docks. He can't get us to go back to work, right? So all these kind of supply bottlenecks, the Fed can do nothing about them. And in fact, they could make some worse. One of the reasons housing costs are rising so quickly is, we went into this pandemic with a shortage of housing. And during the pandemic, we had people moving all over the country because of work from home, showing up in places that weren't ready to have people coming in with cash. I hear you all about this. And then it was hard to build houses and finish them because they couldn't get this stuff like a garage door from halfway around the world. In any case, what we need, the best way to solve too high of housing costs is more housing, right? But when interest rates are high, this makes it a lot harder for construction companies to build housing, and frankly, demand is really falling off, right? So the Fed can actually make supply worse, which is not good. But there are other, there's kind of divine forces of getting out of COVID and these disruptions unwinding. Congress has a role to play, or can have a role to play, in getting inflation down. We have seen decisions from the White House, like opening up the Strategic Petroleum Reserve, that absolutely had an effect on helping bring down oil prices. That's not the only thing. Slowing growth in China, slowing growth in Europe. Those have also taken pressure off of oil prices, because that's a global market. So there are things. There was the Inflation Reduction Act recently. It doesn't move the needle much on inflation immediately, but it does have, one of our first big plans to, deal with getting us moving towards renewable energy, which would get us off of these global markets for fossil fuels, in which dictators and autocrats have a large role that they're playing. So there's important pieces of the Inflation Reduction Act that are helping buffer us from future inflation, which will be coming. So I think that's encouraging to see Congress understand I mean, it was good marketing too, but I mean, there really are things in there that will help us down the road with inflation, and a little bit that helps us here soon. Every little bit helps, right? This is all hands on deck. And more supply is a much less painful way to deal with inflation than what the Fed does. It's not their fault. They only have one tool. It's interest rates. Interest rates, the only thing that they can do largely is bring down demand. Less demand, even if supply is fixed, you get less inflation. They ain't going to stop until they see inflation, until it shows up in consumer price inflation. So this is a little bit of the race against the clock here, the race against the Fed. You will hear a lot of references to we're in the 1970s. We are not in the 1970s. We have a pandemic and a war in Europe. You have to go back a lot further in time to see what we're living through right now. But the 1970s were the last time that we had a decade of inflation. We had an inflation mentality. We've had a year and a half of high inflation and no signs of an inflation mentality, but the Fed does not want to make this mistake again. And honestly, right when Volcker came in, the Fed, they really wanted to break inflation. They raised interest rates extremely fast, and then inflation started to come down. They eased up, and guess what? Inflation came back. So the Volcker Fed, they actually had a double dip recession, and the second one in 80 was it was bad. The Fed does not want to do that. That was a lot of hardship. So they're going to keep at it. Over the course of this year, the Fed has become more and more aggressive in its raising of interest rates, and they have been very clear, and I believe them, even if a recession comes, and if interest rates or if inflation is still high, they will keep raising. They are not going to blink at a recession. So, okay, so the last thing I'll end on, because I do think there is a path forward in the United States. We know how to get inflation down. Inflation right now has already stepped out. We are not that far from the Fed's mandate of what they define as 2%. And there are factors coming at us, a lot of them that almost certainly have to put downward pressure on inflation. It's been a really rough 2.5 years. We are not off this roller coaster, but you can kind of see the station that you're headed towards. I just want to underscore that in Europe, where they're dealing with really high energy prices and they've depended a lot on Russia for supplies, and that is never coming back. So their path forward is a lot less clear, but they're going to get to the other side of it too. I was very impressed with the policymakers and how creative and understanding the urgency they are. So, but one thing that I closed with them, and actually have, in some debating with my peers who are less optimistic, is I tell the policymakers, their advisors, hope is not a strategy, but hopelessness is not either, right? We prepare for the worst, but we still hope for the best, right? So, okay, so that's my dose of hopefulness as an economist. Okay. So I guess this part, hopefully, thank you. That hopefully you all have some questions for me. Again, I learn a lot from the kinds of questions that I hear.
Well, Claudia, first off, I can't thank you enough for pushing through that and giving us a great presentation under the circumstances. So to our attendees here, if you've got any questions, please raise your hand and a member of our staff will bring out a microphone. See one right in the middle here.
First of all, good morning to everybody and appreciate the presentation. It was fantastic. Thank you. Can you just make a comment regarding the service of the debt in this environment where rates are going up, what the government is going to do to pay that debt? Some people are already talking about the debt spiral. So if you can just provide your 2 cents about that.
Yes, so I firmly believe, not just, and this is based on research and, not just making it up. the federal government, it's what we spend it on, not how much we spend, to a limit, right? Like, I'm not saying just let her rip. They're in recessions and crises, deficit spending is appropriate because we have an emergency and we need to help people, and there's long-standing damage if we do not. The spending that has been done since then, like the Inflation Reduction Act, those were a lot of investments. You don't even necessarily have to, the conventional wisdom is if you are investing in the growth of the economy, the deficit, paying for it is not as important. But, you know, if you've done a bunch of deficit spending in the recession, I mean, there is a sense of like getting back on track. And the Inflation Reduction Act was largely paid for, might have been all. In any case, there was a large chunk of it that had reductions in the deficit. We've seen, and this is actually part of the to the blessing of this very fast recovery in the labor market. Tax revenues have come in very quickly, and the deficit, I mean, the federal debt is really high, right? But the deficit, so the kind of change in it, has been negative since. But again, like the debt to GDP ratio is still very high. Interest rates have gone up, but we're not in a place where things are flashing even orange, I would say. But again, it's how you spend it. Federal government needs to be a good steward of all of your money. But I think the policies that have been pursued recently in the United States are in that place, and there's no magic number of debt to GDP where things fall apart. But yeah, debt service interest rates are higher, but I don't think, given the growth, the strong recovery, that's something we should be too alarmed, but always keep an eye on. So I hear you.
With the Fed continuing to raise interest rates and the 10-year Treasury yield continuing to go up, how much damage do you see to the real estate market?
I mean, what mortgage rates are at or around 7, right? I mean, like the mortgage interest rates are high and the Fed is not done, right? So now like you all are like in a beautiful place. I am so upset that I didn't get to come out to Sonoma. So different labor markets, or no, I'm sorry, different housing markets across the country are faring differently at this point. There are some parts of the country that have already seen house prices go down because the demand has weakened so much. I mean, it's become, you know, as mortgage rates have risen, like the monthly payment that people would make, I mean, they've gone up a lot, right? I mean, this is what the Fed wants to see. That's one of the most interest rate sensitive sectors of the US economy. That's their tool, is interest rates. So it's really a demand and supply issue. I mean, you've had a lot of interest, and I think in a lot of really high demand parts of the country. So, you know, if you still have buyers, you still have a housing market that stays together. But I mean, really, interest rates are more, the Fed is not done, probably not even close, and mortgage rates have risen even faster than the federal funds rate. So they have not peaked out. So, you know, that's one of the, that's a cost of buying a house, and that will have repercussions. But again, just like I said with the job openings, if the first thing that happens is instead of 10 people bidding on it, you have 2, you're still going to sell it, right? You might not get the kind of escalation that I'm sure your community has seen maybe in the last year or so.
You pointed to the San Francisco Fed study on a lot of supply side inflation. What are your thoughts on the macro? You know, you got Europe and China, you know, their no COVID policy. How do you see that supply side inflation coming down, if at all?
Yeah, so I think the supply bottlenecks coming out of China or Asia in general, because that's a lot of our goods, or some kind of input like semiconductors or other things that we need to put stuff on the shelves or in the, the dealership. It's true, like the lockdowns in China have had impacts on them getting stuff out the door. However, the slowdown in China, I mean, China's growth is slowing and they do not have the capacity right now to really pump up their economy, which they did in the Great Recession, the financial crisis. China's demand is slowing. That's a really big economy. Europe is either in or going into a recession. So that's demand. So supply in some ways getting constrained, but demand is falling faster. So that means we've seen like the transportation, the shipping costs have come down a lot. The port in LA isn't, backed up in the same way it was before. So again, we're benefiting from the rest of the world really slowing down. And I think it's hurt China more with their zero COVID policies. But I mean, they didn't have an effective vaccine. They have, billion people, right? Like that would cause, I don't know, like you can debate it. It reminds us COVID is not gone in the world. But I don't think we're paying for that for other reasons. I think demand has fallen off faster than that supply. But it's a risk,
I had a question, if I might. What do you see happening with income distribution other than the short-term increase in wages that we're seeing?
Yeah, so one of the, like I said, I worked with Congress on the CARES Act, on the rescue plan, and it's made a difference, okay, in terms of just helping people who've had the least. Those stimulus checks, there were 3 rounds of them for a family of 4, so 2 adults and 2 kids, that put out $11,400 within a year. That's almost 20% of median family income. That is 25% of Black family median income. We are at a point that people at the bottom have a financial buffer. Though inflation is eating into this, but you can see it in aggregate numbers that the Federal Reserve publishes. People at the bottom have a financial buffer that they have never had before. People at the top, they always have a financial buffer, like one that's massive. But it's very clear that the aid, the relief that went out really helped a lot of people. And you'll hear arguments it went beyond the imperative of need and like they didn't need all this money. But frankly, I think you can make a case that people have been shortchanged for a long time. And talking to another macroeconomist actually it was the podcast that your organizer heard me on, and I got invited to this. Mark Zandi, so he's a well-known forecaster, I think a real smart one. He said, I'm just, because consumer spending's holding up, right? Like people are like, Fed, I'm gonna still buy stuff. He said, I'm so surprised, like people had all this extra money, and like they still have it, like they didn't just spend it all. Like there was really a belief that people would spend it down and be gone, and then they'd have to cut back. And I told Mark, I said, there's a lot of people that just believe poor people they can't save, like they get money and they go out and spend it. I said, honestly, poor people don't save because they don't have any money, right? Like if you give them money, if they have better paying jobs, well, everybody wants a buffer, you can pull it off. So, I think the main point is income inequality in the United States, wealth inequality in the United States is massive, right? Just the top 1% just have a massive share of the wealth. But we have seen improvements. I mean, the low-wage workers have had increases. The relief money was, really helped out. That employment benefits were generous. But I tell people, like, the labor market institutions in the United States have not changed. We do not have labor unions that will continue to bargain for workers. People will come back, the labor market will cool off, workers will not have the leverage. So, you know, I don't expect these big wage gains going forward, but I think of it as a proof of concept. Like, for a long time, many corporations have said, these low wage workers aren't worth it. Well, guess what? When you need them, they're worth it. So I don't think, you know, there's a lot of policies that have to be done, like long-term investments in people, in children, that will, those are the only things that are going to move the needle. But, you know, it's not baked in the cake. We did see some real improvements in the last few years, even though we were going through such a horrible time. So.
Morning, Claudia. Thanks for joining us. Sonoma County does have a cure for COVID. It's wine, Sonoma County wine. I'm sure Ethan can get some sent out. Question is, it's really unique to hear all of these statistics about the inflation, job market. I think some of the traditional definitions of recession may warp or change from this. But how's that going to play out as the job market is still hot, maybe because of the inflation? So as inflation controls, does the job market sort of cool off, and does that start to be a catalyst into the tiptoeing or full-blown recession? I don't think it'll be a full-blown recession, but possibly tiptoeing that way. And then second part to that question is, will the Fed consider the holiday season coming up and start to look at interest rates, what they do with consumer spending, and be careful about that?
Oh, I'll start with the second one, mainly because my job for years at the Fed was being a lead on consumer spending. I have spent so much time with holiday spending, seasonality. I mean, I can't even explain. I mean, I'm sure for those of you that, like, you're like boots on the ground actually selling things. And I know for a lot of businesses, a big part of their annual revenue comes at the end of the year. The statistics that the Fed looks at, and macroeconomists, they're, you know, seasonally adjusted, right? So in a sense, if we didn't do seasonals, every January would look like we had a recession, right? Because you have all the spending at the end of the year and then it drops off. The way the Fed looks through that, because those are regular patterns. I mean, those of you that work, like, you're used to it, you can plan ahead for it. So typically that holiday season gets washed out of, like, the statistics, the Fed, as long as it isn't unusual, right? Like, the seasonal adjustment is kind of the usual pattern. There are definitely times where, I mean, the recession in 2008 started at the end of 2007, right? So if things start to slow even more, right, or the shortfall, like, so they look at that piece. And I mean, really, I spent a lot of time reading the, you know, the industry stuff on the holidays. And before me, the guy who did the consumer spending every December when we prepared for the FOMC meeting, he'd bring a list of like the top 10 toys for boys and for girls. Right? We retired that after he left. But I don't, you know, it's a gauge. They're going to be looking at spending at any point in time relative to the usual patterns, and inflation at any time. So, but I understand where there could be those bottlenecks, and we'll see. But yeah, there's not a particular focus at the end of the year versus the beginning. So on this labor market cooling off, which basically means people get less wage increases or they get laid off. I mean, the Fed likes to use little euphemisms, but, like, you know, it's not a soft thing for the workers who are affected. So in the United States, consumer spending is about 2/3 of GDP, right? And I showed you before that that's really like an underlying part of growth, right? Because if it's strong, it tends to stay strong. Like, you know, the bottom falls in. For most Americans, they spend what they earn, right? Labor income is a really important part of, I mean, when I forecasted consumer spending, the best predictor of consumption was income, right? And so if people lose jobs, they lose income. If wage growth slows, that doesn't mean that they stop spending. Like they just, maybe don't spend more and more at the same pace. And again, you do have families that have these buffers. So it's this tricky place of growth needs to slow, so it takes some pressure off of inflation. But if it slows too much, it goes in reverse. I will say one thing about the Fed that, I think I was a little down on them because I'm kind of annoyed that they're not being around the world, which is falling apart. But the Federal Reserve, the Powell Fed, is not trying to cause a recession, right? And Fed officials have been very clear. Mary Daly said this yesterday, we do not need a severe recession. There are some of my peers, who go around saying we need 6% inflation, we need a severe recession. The Fed does not believe that. The Volcker Fed, after a decade of high inflation, they were trying to cause a recession, right? Like there was no question about they were trying to break the inflation rate. That is not the Fed today, right? So that's no guarantee that we don't end up in a recession. Again, they're absolutely committed to getting inflation down. But yeah, as the labor market softens or cools off, the customers soften a little bit. So it does, and that's a cycle. Once it gets going, it can be hard to stop. And actually, that's this Sahm rule, this recession indicator. I look at the unemployment rate, the national unemployment rate, smooth it out a little bit, look at 3-month changes. I compare the most recent value to the lowest over the past 12 months. If that increase is a 0.5 percentage point or more, then we are a couple months into a recession. 0.5 percentage point is not much. Like a typical recession would see the unemployment rate rise 2 percentage points or more if it's a severe one. And that's because once the labor market starts to and the Sahm rule is 0 right now. So we're not in a recession. You get this dynamic, this feedback loop of some workers get laid off, they spend less. Well, then if there are fewer customers, then businesses lay off more workers. And so this dynamic starts going, and then people panic some and spend less. So that's why once this downward spiral in spending gets going, it tends to go into a recession. So, but it doesn't. We are living in a very unusual time. There are the kind of statistics the Fed looks at, or anyone working in kind of macroeconomics, like they almost don't make sense, right? Like GDP is falling, but the labor market is adding all these jobs, right? So there's all kinds of relationships that we would usually use, and they're like all breaking. But we have a pandemic and a war in Europe. Like this is not normal. So that's why it becomes very hard to do any kind of forecasting, because it's like every month is a new puzzle. So sorry, that's not encouraging, but because it is such an unusual time, I think that leaves open the case that we might get out of this without a recession, which normally, given all the constellation, that wouldn't be my expectation. But
All right, we have time for one more question. Mr. Patience Al-Lerma.
Yeah, hi. Thanks for your presentation. You haven't mentioned immigration at all, so I'm guessing right about now the governor of Florida is wishing he might not have bust out some of those folks out of Florida to help with this disaster, and like what happened in Katrina, and like what happened here in Sonoma County in Coffee Park and rebuilding that neighborhood. So your thoughts on that, on immigration and how that might affect the near future?
Yeah, so this is one example of many that we can point to where a problem, a structural, and I see immigration as a good thing, okay, where you have a problem before COVID and COVID just crashed into it, and the two things together made it worse, okay? Immigration to the United States, both what we would consider, people with a lot of education, a lot of credentials had been falling before COVID, as were a lot of the workers that would help build those houses, help be in agriculture. So that had been slowing considerably. I mean, these were decisions made under the Trump administration. And frankly, before that, they were slowing, although more of natural causes. And, you know, these people would be working in the United States and they're not here. So, I mean, one very clear way to help with labor shortages, particularly in some of the agriculture sectors. I grew up on a farm, right? Indiana hog farm. The absolute best worker we had, he and his family came out of Mexico, like just amazing, great person, and had been in construction before that, right? So we really miss out when we aren't bringing people in who really see the United States as a place to contribute and grow. But I mean, this is not changing. I mean, the current administration has not taken moves to open up immigration, and it's a very contentious issue. So I don't want to act like just because the economics of it are good, you know, I'm sure there are people that absolutely disagree, but that's been a very problematic trend in terms of our workforce, especially as we age, right? Like I mean, a big part of the labor force that we lost in COVID, I mean, frankly, we lost them, like they're gone, but also just in terms of not wanting to come back to work are the older workers that we've had. I mean, you know, they get sick, it can be really serious. And that's actually a lot of those part-time jobs and people kind of filling in, like that's not, those jobs haven't come back. So the United States has a particular advantage, actually lots of them, but one is a lot of people still want to come here. Like we're still a place to get ahead. And we have the ability to offset a lot of that aging of the population. I mean, people that have earned the, you know, to retire, not have to go in every day, but like we're not doing that as a country right now. And I don't expect that to change anytime soon, because I mean, really across the spectrum, there's not a lot of appetite for that. So, sorry, that was kind of a downer, but you know, that could turn around, and immigrants have made a lot of contributions to this country. And I mean, I think that hopefully at some point will be recognized and we'll welcome them.
Thank you very much, Claudia.
So, thank you.
We'll see about another chance to get you out here to beautiful Sonoma County.
Yes.
Thank you to our sponsors. Thank you to everybody for being here in person, for sticking around a few minutes longer. It's great to see you. Go out and have a wonderful Friday.
Thank you.